Have you ever wondered why some people seem to turn a relatively small investment into life-changing wealth, while others spend decades saving and still struggle to get ahead? Imagine starting with just $10,000 and watching it grow into $100,000. It sounds like something only Wall Street experts can do. But the truth is that countless ordinary Americans have built six-figure investment portfolios by following simple principles consistently over time. The biggest secret isn't finding the next hot stock or getting lucky with cryptocurrency. It's understanding how money grows, making smart decisions, and allowing time to do the heavy lifting. In today's video, we're going to break down exactly how turning $10,000 into $100,000 is possible, the strategies successful investors use, the mistakes that destroy wealth, and the realistic timeline you should expect. By the end of this video, you'll have a practical roadmap that can help you build long-term wealth without gambling your financial future. The first thing you need to understand is that multiplying your money by 10 doesn't happen overnight. Social media is filled with stories about people making massive gains in weeks. But those stories rarely mention the enormous risks or the countless losses behind the scenes. Smart investing isn't about chasing excitement. It's about creating a repeatable system that works regardless of what the market is doing. If you expect to turn $10,000 into $100,000 in a year, you'll probably end up taking unnecessary risks that could wipe out your savings. Successful investors think differently. They focus on consistent returns, disciplined investing, and patience. One of the most powerful forces in investing is compound growth. Albert Einstein is often credited with calling compound interest the eighth wonder of the world, and whether or not he actually said it, the principle remains incredibly powerful. Every dollar your investments earn begins generating returns of its own. Over time, those returns create even more returns, producing a snowball effect that becomes larger every year. This is why investors who stay invested for 10, 15, or 20 years often see dramatic growth compared to those who constantly jump in and out of the market. Let's put this into perspective. If your investments average around 10% annually, which is close to the historical long-term average return of the U.S. stock market before inflation, your money roughly doubles every 7 years under the rule of 72. That means your original $10,000 could become $20,000, then $40,000, then $80,000, and eventually surpass $100,000 if you stay invested long enough. The key lesson here is that time is often more important than trying to find the perfect investment. Of course, smart investing also requires choosing the right assets. Many experienced investors recommend broad market index funds and ETFs because they provide instant diversification across hundreds of companies. Instead of betting everything on one business succeeding, you're investing in the overall growth of the American economy. Historically, companies have come and gone, but diversified portfolios have rewarded patient investors over long periods. Trying to pick individual winning stocks may sound exciting, but even professional fund managers struggle to consistently beat the market year after year. Another powerful strategy is consistently adding new money to your investments. Imagine you start with $10,000 but continue investing $500 every month. Those regular contributions dramatically accelerate your journey toward $100,000. This strategy, known as dollar cost averaging, allows you to buy investments regardless of whether prices are rising or falling. When prices drop, your monthly investment buys more shares. When prices rise, your existing investments increase in value. Instead of trying to predict market movements, you're letting consistency work in your favor. Tax efficiency is another factor many investors overlook. If you're eligible, investing through accounts like a 401k, traditional IRA, or Roth IRA can significantly improve your long-term results. A traditional 401k may reduce your taxable income today, while a Roth IRA allows qualified withdrawals to be tax-free in retirement. Depending on your situation, these accounts can help more of your investment returns stay invested rather than going to taxes. It's always important to understand IRS contribution limits and eligibility requirements before making investment decisions. Diversification is equally important. Putting all $10,000 into a single stock or a trendy investment might seem like a shortcut to wealth, but concentration dramatically increases risk. Smart investors spread their money across multiple sectors, industries, and asset classes. Even when one area struggles, others may continue growing. This balanced approach may not produce overnight riches, but it greatly improves the odds of achieving long-term financial success. Now let's talk about the mistakes that keep people from reaching $100,000. One of the biggest is emotional investing. When markets fall, fear convinces many investors to sell at the worst possible time. Then, after markets recover, excitement causes them to buy back at much higher prices. This cycle of panic selling and emotional buying destroys wealth. The most successful investors understand that market volatility is normal. Temporary declines have occurred throughout history, yet markets have repeatedly recovered over the long term. Another common mistake is chasing trends. Every few years, a new investment becomes the hottest opportunity. Whether it's meme stocks, speculative cryptocurrencies, or companies making unrealistic promises, investors often rush in after prices have already skyrocketed. By the time the average person hears about these investments, much of the opportunity has already passed. Smart investors focus less on hype and more on strong businesses, diversified funds, steady cash flow, and long-term fundamentals. Risk management is another essential part of growing wealth. Smart investing doesn't mean avoiding risk altogether. It means understanding how much risk you're taking and ensuring it matches your financial goals and timeline. Money you might need within the next few years generally shouldn't be invested aggressively in stocks. An emergency fund should remain in a high-yield savings account, so unexpected expenses don't force you to sell investments during a market downturn. One habit shared by many wealthy investors is continuous learning. They don't simply invest once and forget about personal finance forever. They regularly read financial books, follow economic trends, understand company earnings, monitor their asset allocation, and review their long-term strategy. Knowledge reduces emotional decision-making because educated investors understand that temporary volatility is part of building long-term wealth. It's also important to have realistic expectations. Turning $10,000 into $100,000 is absolutely achievable, but it requires patience, discipline, and consistency. There is no guaranteed shortcut. Anyone promising guaranteed returns, secret IRS loopholes that magically create wealth, or risk-free investments with extraordinary profits should immediately raise red flags. Sustainable wealth is usually built slowly, not instantly. Imagine where your financial life could be 10 or 20 years from now if you simply committed to investing consistently, avoided emotional mistakes, reinvested your earnings, and allowed compound growth to work in your favor. That one decision today could change your future retirement, provide financial security for your family, and create opportunities you never imagined possible. Wealth isn't reserved for the lucky or the wealthy. It's often built by ordinary people making extraordinary decisions consistently over time. The journey from $10,000 to $100,000 doesn't begin with finding the perfect stock. It begins with developing the right mindset. Start with a clear plan. Invest in quality assets. Contribute consistently. Stay diversified. Use tax-advantaged accounts whenever possible. Ignore short-term market noise and give your investments the one thing they need most: time. If you can master those principles, you'll be following the same playbook that countless successful investors have used for decades. Your first $10,000 may seem small today, but with discipline, patience, and smart investing, it could become the foundation of lasting financial freedom. If you found this video valuable, subscribe for more practical finance strategies. And remember that every great investment journey starts with a single smart decision.